Everybody knows we're either getting into a recession or it's going to be close to a recession.
I expect inflation to get to 7%. That's a very high number, and we need to be able to chart a course back to 2 to 3% inflation.
Growth has bottomed. The recovery just started. It's still a very incomplete and bumpy recovery, but we have seen the worst.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Wednesday, the 15th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Emergency meeting. The ECB will hold an ad hoc policy meeting starting at 11 a.m. Frankfurt time today. Italian bonds surge, the euro rallies. Consensus builds for a 75 basis point Fed rate hike. Bill Ackman says 100 basis points would be better. Jeff Gundlach says or goes one step further and urges Powell to take rates to 3%. And traders put up a challenge for the Bank of Japan. JGB futures slide the most since 2013, even as a central bank ups bond buying. So, big market day. Of course, we were going to call it Fed Day, but it feels like it's an ECB morning, and then we go on to the Fed. So let's get straight to the markets. Central banks today, of course, dominating the narrative overall. Investors' calls for more aggressive hikes from the Fed are growing. Consensus now for a 75 basis points hike, while Bill Ackman says that 100 basis points may be better. Now, not to be beaten, Jeff Gundlach says the Fed should immediately hike to a 3% funds rate. Now, the UBS chief economist Paul Donovan warned it yesterday against exactly this kind of competitive forecasting.
I think the biggest inflation threat we face at the moment is pundits inflating their Fed forecasts and competing frantically to get up with the highest possible number.
Meanwhile, the Bank of Japan stepped up JGB purchases as bonds spiraled out of control. The 10-year futures slumped by the most since 2013, while the yen tumbled to a 24-year low. And the ECB sent the euro and stocks higher after announcing an emergency meeting this morning that's set to kick off at 11 a.m. Frankfurt time. Italian 10-year yields fell as much as 29 basis points. They'll discuss PEP bond reinvestment, and we spoke to the EU Finance Commissioner, Merit McGuinness, following the announcement, who said the ad hoc meeting was a positive note.
The ECB is doing its job, so I think that's important. I'm not going to second guess the conversations that will take place at this meeting, but clearly since the beginning of this year, and particularly since the invasion, the illegal invasion by Russia of Ukraine, there is uncertainty in markets. Full faith in our institutions to deal with uncertainty and prudence as well, so that we are ahead of issues. So let's see what emerges, but clearly the ECB is right to be active and to do its job.
Well, joining us now, Enda Kern, our chief Asia economics correspondent, Maria Tadeo in Brussels. So thank you both for joining us. Enda, the Fed is hiking today, of course, abandoning gradualism. What does this do for their credibility?
Well, I think there are question marks now because this expected sudden move, the biggest since 1994, Francine, is putting a lot of focus on just how badly wrong central banks, not just the Fed, but central banks around the world have read the inflation surge. Their forecasting has been wrong, their forward guidance has proven to be wrong, markets have already moved ahead of them, and instead of inflation proving to be transitory that they were forecasting 6 months ago, we're in a position now where analysts are worried that these interest rates that are soaring up at such a rapid clip will do enough to tip the global economy over into stagflation, if not outright recession. So certainly plenty of scrutiny around central banks now, and that's been sharpened by the expected Fed decision today.
Maria, what can we expect from the ECB meeting? So we heard that this is basically a flexibility or reinvestment of PEP. We knew that they had that flexibility, which is why it disappointed markets. Are we expecting more than that from the ECB today?
Well, Francine, this was a meeting, of course, that dropped like a bomb on investors today. It is coming almost a week to the date of that European Central Bank decision, which many out there in the market found very underwhelming. And of course, we've seen investors pretty much day in and day out test the European Central Bank, particularly piling on BTPs. Now, in terms of this meeting today, not a lot of detail around it or the actual content of it, but we do have a story now on the Bloomberg, the team in Frankfurt, saying the bulk, the core of the discussion will be around the reinvestment of the PEP program. Now, Francine, if you look at the issue here. This all started because of the lack of detail around the fragmentation tool. Yesterday, Isabelle Schnabel, in a speech in Paris, said our commitment to this anti-fragmentation has no limits. So the issue here, and this is what I've heard repeatedly this morning from traders, is that if this meeting focuses exclusively on the reinvestment, there's a lot of potential for disappointment. In theory, what the market wants to see is very clear guidance at what level, what type of action would trigger intervention from the European Central Bank, what the stool would look like. So there is a lot of potential for this to disappoint many by the end of the day.
Thank you so much, both of you. Of course, Marie Tadeo in Brussels and Enda Curran, our Chief Asia Economics Correspondent. Now, joining us now is Ven Ram from our Markets Live team. Ven, I thought we were going to have a conversation on treasuries. Forget that. I mean, it's all happening at the ECB. Is there a real danger that they talked up the market, or that they built up expectation in the market, that they're having this ad hoc meeting, that we could even have an instrument to deal with fragmentation once and for all, and we're just not going to get it?
Absolutely. I think that risk is front and center. And as Maria was just saying, there's a risk that the markets will find it underwhelming if all they are going to say is that we will formalize our PPP reinvestments into peripheral yields. So if that's all they are going to say, the markets will be underwhelmed, and we'll see a bigger sell-off in Italian and peripheral securities, because the markets have now smelt blood.
Yeah, and I guess the point is that also flexible reinvestment of PEP is nothing new, right? We knew that they had that flexibility.
Absolutely. We have known it for months, and that is going to be underwhelming for the markets. They need to come out and say, look, here's really a plan to backstop peripheral bonds, and they need to do it emphatically with a plan that convinces the markets that the ECB is here to backstop, and they have the sufficient firepower and ammunition to do so.
But the concern, and I've heard, from various sources in the Governing Council, that actually, they see this as political, and some in the Governing Council see us at giving a free ride to some of the periphery, Italy basically. Is this about needing a tool to deal with just excessive moves overall? And is this what the market wants, or do they specifically worry about Italy at the moment?
I think they are specifically worried about Italy at the moment, because if you see the yields on Italy, they've risen far more emphatically than even in Greece, which is lesser rated than Italy. So I think that's a bigger problem they need to address, and it's a nationalist issue, as you mentioned, and it's more the political will and how they are going to discuss this framework. The long-term issue here that they need to solve is, these are fiscal issues that they need to resolve. This is not monetary policy. Yeah. Of course, monetary policy can only do what it can do, and it's very limited in what the ECB can do to help peripheral spreads here.
Given all the disagreements, what is the chance of getting some kind of permanent crisis tool resolution on this? And do you think the markets will just test it until we get something, or will talking be enough?
I don't think talking is going to be enough. The markets, a lot will depend on what the ECB is going to say today. If it proves underwhelming, as I said, the markets have already smelled blood once, and they will keep pushing the ECB to the limits to see what it is they can come up with. But ultimately, this is a fiscal issue, and it's up to the governments, the sovereign governments. It's not easy running a central bank that oversees 19 different economies. That is a unique problem to the ECB, and it's not the ECB that's got to be swimming alone here. Yeah,
are you expecting 75 basis points from the Fed? Because I'm not, but I'm like alone. I don't even do market predictions, but I just don't think they'll go through with it.
I think they will go through with 75 basis points, simply because if you had asked me earlier this week, I would have said 50 basis points, which is, I think, what I was saying. But with that, the Fed, the Wall Street Journal report changed everything. Yeah. And why does it matter what the Wall Street says? Because the Fed often uses the WSJ as the conduit for whatever it is that they want to position the markets for. Yeah. And if you see the positioning in the markets are fully pricing in 75 basis points today. So there is no room for them to disappoint the markets at this stage. So I do think that we will definitely get 75.
Yeah. Okay. Do you remember what the Bank of England did? 18 months ago, when they disappointed markets.
Well, absolutely. The Bank of England is in a different kettle of fish, because their messaging has been all over the place. And it's not like the Fed. The Fed has been consistently following up on its messages, and they've kept to the word. In this case, in this particular week, they had an emergency situation to act, and that's what they're doing.
Yeah, and it is 100% fully priced in. Ven, thank you so much, as always. Ven Ram there from our Markets Live team. Coming up, under pressure, oil dips ahead of the Fed meeting as the IEA report sees the world struggling to meet demand in 2023. We speak to the organization's head of oil markets, Tora Blazoni. She's up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it is Fed Day, also ECB Day. Oil fluctuating ahead of today's meeting that's expected to abandon gradualism and hike by 75 basis points to combat rising U.S. inflation. At the same time, the IEA has released its latest report on oil markets, and it sees the world oil supply struggling to see demand in 2023. Well, joining us now is Tora Blazoni, head of the oil market division at the International Energy Agency. Tora, as always, thank you so much for making time to speak to Bloomberg TV. What does this mean for oil prices? How much of a headache will they be, and how high can they go?
Thank you, and thank you for having me today. No, so we're seeing, as we say in our report today, oil demand is clearly slowing. Higher prices, the weaker economic outlook is denting oil demand. We're seeing signs of a slowdown in transport fuels. And in 2022, we're seeing oil supplies rising, being able to meet that demand mostly. But as we flip into 2023, as OPEC Plus bumps up against their capacity constraints, oil demand recovers, especially for China. The market are looking incredibly tight, and the buffers that we have, inventory, spare capacity in production, and refining capacity tight, the market is looking stretched.
So, Tora, given where we are and given prices, I imagine, can really spike up, is there anything that you're hoping President Biden can achieve in his visit to Saudi?
Well, we're already seeing that the OPEC Plus agreed, as we know earlier this month, to accelerate the phasing out of production cuts that were expected to end in September. And now we're seeing slightly higher increases over July and August, and that's very welcome in a tight market. So we're hoping OPEC Plus spare capacity is concentrated in Saudi Arabia and the UAE primarily. And in this market, higher production will be welcome indeed.
What can heal the market? I mean, if it's not extra production, does the fact that certain refining capacity get back online, how much does that help?
So we're expecting now that refinery maintenance is coming to an end in Europe and the US and gradually in Asia as well. We are expecting a strong rebound in refinery activity from May to August, so about 3.5 million barrels a day. That will help ease market tensions in the products. Moving into 2023, we're also seeing a number of new refineries coming online end of this year, next year in Africa, in the Middle East, China. This will also help ease the tensions that we're seeing now in product markets.
So, Tora, overall, and I know you hate discussing prices, and rightly so, because they're so impossible to predict, but are we really in a danger zone? Could they even go above 150?
I think there is a lot of risk that we see in the market today. Most recently, we're seeing production in Libya falling due to unrest there. We heard just a few days ago that Libyan production fell to 100,000 barrels a day. This is obviously coming at a very crucial time as European refiners are looking to increase refining activity and are looking for those sweet barrels to produce gasoline and diesel ahead of the summer season. We're also seeing there have been news about or forecast about a very active hurricane season in the U.S. this year. With such small buffers in the market, as I said, inventories are 300 million barrels a day below their 5-year average. Product inventories are very low, and with spare capacity, we don't have the buffers today to offset any unforeseen losses elsewhere. So I think the market would remain volatile, and clearly there is a risk that prices will move higher. But as we heard, with inflation running ahead, the weaker economic outlook, as we move forward, demand risk could also be to the downside.
How difficult is it to see when the resurgent Chinese economy also bolsters consumption? Is there a peak oil demand sometime, right before the winter of 2022, or what's the timing for that?
So in our forecast, we're not seeing peak oil demand in this horizon. For China, the losses that we've seen due to their COVID restrictions have been much more severe than expected. Chinese oil demand in April and May were 1 million barrels a day below last year. And we're seeing that we're expecting a gradual recovery in Chinese demand through the rest of the year. We're seeing restriction easing. But our forecast now is that Chinese oil demand will decline for the first time on an annual basis in 2022 in more than 20 years. But as China recovers, that will increase oil demand growth in 2023. So we're actually seeing higher oil demand growth next year compared to this year, despite the deteriorating economic outlook and higher prices as China rebounds. So Chinese oil demand in our forecast will grow by 1 million barrels a day next year, taking global oil demand up by 2.2 million barrels a day compared to the 1.8 that we forecast for 2022.
Toriel, thank you so much, as always, for joining us. Toriel Bazzoni, they're head of the oil market division at the IEA. Now, coming up, we speak to leading global investment firm KKR at the Super Return Conference. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the world's largest private equity and venture capital event, Super Return, is back this week, and investment firm KKR is at the event, having raised $7.1 billion in the first quarter of this year with its 6th European flagship fund. Well, I'm delighted to be joined by Danny Berger, who's in Berlin with a great guest. Danny, over to you.
I am indeed, Francine. I'm here with Philipp Freise, co-head of European private equity at KKR. Philipp, thanks so much for being here with us in Berlin. So one of the things that KKR is really notable for was during the pandemic, the most active fund buying up things left and right when basically everyone else was frozen. Here we are in the midst of another crisis. Is it the same?
Danny, it's great to see you and thank you for having me. It's true that COVID was a crisis that we prepared for. We didn't know what would happen, but we knew after a 10-year bull market something would happen. This crisis is different. We all knew inflation would rise. We all knew that interest rates would rise, but nobody obviously had this war on their radar screen. What I can tell you is it is similar in the sense that it's accelerating rapid change, especially here in Europe, that presents an incredible investment opportunity over time. But it's different in the sense that I can't tell you that this will be over within a predefined amount of time. We just don't know, and therefore we're battening down the hatches for sure in our portfolio, but also in our investment approach.
What is that conversation like with portfolio companies? Are you preparing them for a recession?
It is important to note that after the record stimulus, it is clear that central banks will have to continue hiking even if we have a stagnating economy. Therefore, when we prepare our portfolio companies, we certainly are having a conversation around cost control, around making sure that you really prepare for an outcome where you don't get back to immediate stimulus.
Coming off the back of a really record period for private equity, last time we were at this conference at the end of last year, everyone was kind of cheering how good of a period it was. Do you think that cheer is going to remain considering how difficult of an environment you're describing?
Our job as an industry is to fundamentally change the companies we invest in. So now's the time. It is clear that now that the tide is coming back, we see who's swimming naked. There's going to be much more differentiation. It's not enough to just put capital in your companies. You have to fundamentally transform them, internationalize them, prepare them for this energy transition, digitize them. So as an industry, the ones who can do this, and as a firm, we very much focus on this.
What about valuations? Because part of that being left out to shore, seeing who's left naked, is part of that people who just overpaid for companies that in this current environment, it doesn't seem worth that price anymore.
It is clear that, we invested the bulk of, our latest fund during COVID. It is clear that valuations came to a level that was non-sustainable. growth was priced at 2x what it was priced before the second half of last year. We will certainly continue to see an adjustment. If you look more broadly, the S&P 500 is still roughly 15% higher than we were in January 2020, so before the onset of COVID, and the DAX roughly 7-8%. So this has not gone through. Our investment approach is to partner and to fundamentally change the company so we are less exposed to the entry valuation.
So they might still be elevated from COVID, but this year obviously markets have fallen a lot. DAX I think has fallen, some 17%. Quickly here, but Philipp, are you seeing take privates look more attractive with that fall in price in the public markets?
We have a period of adjustment now. The human psyche is you're not going from a bull market mentality to a bear market mentality within weeks. It'll take time for people to realize that this is not a blip. This is the new reality that we face over the next year, 2 or even longer.
Right.
And once we are through that, we definitely, in our view, will see more take privates and more of that type of opportunity, yes.
Philipp, I'm afraid that's all we have time for. Thank you so much. Francine, that's Philipp Freise of KKR.
What a great interview, Danny. Thanks so much. I'm looking forward to all of the interviews that Danny Berger is doing from the Super Return Conference in Berlin. Now, coming up, we'll head to Paris, where the Publicis chair, Maurice Lévy, also joins us from the Vivatech conference with his outlook for global markets and economies. That's next. This is Bloomberg. Emergency meeting. The ECB will hold an ad hoc policy meeting starting at 11 a.m. Frankfurt time today. Italian bonds surge and the euro rallies. Consensus builds for a 75 basis point Fed rate hike. Bill Ackman says 100 basis points would be better. Jeff Gundlach says, goes one step further and urges Powell to take rates to 3%. And traders put up a challenge to the Bank of Japan. JGB futures slide to the most since 2013, even as the central bank ups bond buying. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the ECB's Governing Council will hold an ad hoc meeting today to discuss current market conditions. That's according to a spokesman for the bank. Now, the council will discuss PEP bond reinvestment as a response to the crisis, and that sent the euro and stocks higher, with Italian 10-year yields falling as much as 29 basis points. Now, we spoke to the EU Finance Commissioner, Mairead McGuinness, following the announcement, who said the ad hoc meeting was a positive move.
The ECB is doing its job, so I think that's important. I'm not going to second guess the conversations that will take place at this meeting, but clearly since the beginning of this year, and particularly since the invasion, the illegal invasion by Russia of Ukraine, there is uncertainty in markets. Full faith in our institutions to deal with uncertainty and prudence as well, so that we are ahead of issues. So let's see what emerges, but clearly the ECB is right to be active and to do its job.
Well, joining us now is Bloomberg's chief Europe economist, Jamie Rush. Jamie, first of all, the market is not at all pricing in some kind of breakup, right? So when we talk about fragmentation and the spread, it's still not as wide as it could be if something really ugly were to happen. So is it right that the market is putting so much pressure on the ECB to come out with the tool now?
I think it's the uncontrolled nature of the rise in yields, which is what's worrying the ECB. I mean, clearly the Italian yields have moved above 4% this week. That's the highest since 2014, I think. So things are moving very quickly, and there are actually two elements to the move, right? It's not just spreads that's the issue. It's also every time the ECB markets price in a higher ECB policy path, they're pricing in a higher terminal rate as well. So the ECB's got this problem where spreads are widening and it's kind of losing the narrative on rates in the medium term as well. So I think it's got quite a few things to deal with.
So, of course, if they're only talking about reinvestment of PEP bonds, this is the flexibility that we already knew they had. So how much of a disappointment would that be?
I think it'd be very disappointing. I mean, one thing they can do is that even at the height of the pandemic, when they flexed PEP, they didn't flex it by very much. Like the capital keys they deployed, it wasn't hugely flexed. So I think if they're going to use reinvestments, they need to be willing to commit to doing a lot more than they have last time. Like so, shifting the skewing purchases much more to peripheral debt rather than debt as a whole. If they don't do that, then there's no credible solution here. At the end of the day, there's only going to be a credible solution when markets really do tank, when there's an actual existential Eurozone crisis. That's when a political solution will become available.
But Jamie, do you think the markets will test that and test the ECB's resolve?
Yeah, I think they will. Yeah, I think we're seeing it now, and I think it's going to continue through the summer. So the ECB needs to do something.
So basically, if the ECB act now with more force, it would, at the end of the day, just be cheaper for them. Why are they reluctant to do so? How much division is there within the Governing Council?
I mean, I think there's huge resistance to using asset purchases in an environment of high inflation. It's extremely difficult to persuade the Hawks on the Governing Council that that's the right strategy. I think what can be done, and it would be potentially constructive, would be saying a little bit more about where the ECB sees hikes topping out. This is one element of the yield curve that the ECB has a lot of control over. If it says we think rates are going to 1.5%, markets will take that on board probably. I think actually if they're going to do something soon to contain this thing, I think actually that would be one of the simplest things they could do, is just try and regain that control over the narrative on medium-term rates.
Okay, great. Thank you so much for the insight. Jamie Rush there from Bloomberg Economics. Now, joining us to talk, of course, about inflationary pressures, advertising, the risk of recession or not, is Maurice Lévy. He's chairman of the advertising giant Publicis and founder of the Vivatech event in Paris. So thank you, Maurice Lévy, first of all, for joining us. I wish it was in person, but next time we'll be there, or you'll be in London. First, what is the main concern that you see right now in the advertising space when it comes to recessionary risk? Are your clients spending less?
We are expecting that there will be probably some slowdown, and that has been the last forecast of Zenith as well as Group M, showing that instead of 9.5, 9.6% that we were expecting for this year, will be more at 8.7. So it is still a huge growth compared to last year, with a small slowdown. We are not seeing any sign of recession. It is still quite strong, but there are some signs that are showing that in some areas, due to either supply chain or the issues of inflation or the issues regarding the war in Ukraine, there is that little retention of investment, but it is, and I want to underline it, it is still based not only on our research, but also on the forecast of our competitors, a quite strong year. In fact, a very strong year, because more than 8% of growth is something that we have not seen for years.
Mauricio, do you worry about inflation? And will your clients, as we talk about inflation, as central banks are starting to normalize, how much tougher will their environment be, especially for the companies that are not able to pass on this rising inflation to their end customers?
The problem of inflation is that there are many different situations. There is the one who are passing, like energy, the inflation to the consumers, and in packaged goods and food, beverages, etc., there is an effort which is made by both the producers and the retailers in order that the impact on consumer is as reduced as possible. It's not something which is easy to do. So you have many different patterns as according to the kind of industry you are in, and the inflation has not yet been with its full impact on the companies. So we believe that there will be some impact. We don't know exactly how long it will last, and everyone is expecting that there will be a solution in the war in Ukraine in order that things can be calmed down and we can go back.
So when do you think the full impact of rising inflation to hit? And again, if you look at your clients, given you know them very intimately and do a lot of the advertising for them, how many of those clients will be able to increase their prices without hurting market share?
I think that what will happen is that things will go up, and probably the peak will be in the fall. And I think, as always, when there is a situation of the like, people will have to deal with an equation where either they protect their margin or they protect their market share. Margin is something which is extremely important, obviously, but what is extremely important for the future is market share. So I think that the people who will reduce dramatically investment will be relatively limited, because when you lose market share, this lasts forever. It's very, very difficult to get back at the level that you had before. So therefore, I don't anticipate that people will cut dramatically their investment. I believe that in the interest of the company, they will have to protect their market share and spend according to their position.
And this, Monsieur Levy, would also be in a recessionary environment. How tough is it looking for, for the economy to, or for central banks to engineer a soft landing?
On that front, I think that nobody knows exactly what will happen, and I'm at Vivatech, and I forgot to take my crystal ball with me, so therefore I cannot look at what the future will be exactly. But when you look at the position of Christine Lagarde or Jerome Powell, on the other hand, you see that they are quite cautious. They are raising interest in a moderate way in order to create a balance between protecting inflation and at the same time not hurting too badly production and commerce in general. So if we want to have a GDP which is protected, we need to accept a certain level of inflation, knowing that inflation will not last forever.
All right, always great analysis. Thank you so much, Maurice Levy there, the publicist and chairman and Vivatech founder, of course. So we'll spend a lot of time talking about Vivatech and some of the great things that we've seen coming out of that conference. Tomorrow, we also go back to Vivatech and speak with the Binance Chief Executive Officer, all about cryptos. Now, coming up, Super Return International, the world's largest private equity and venture capital event, is also currently underway in Berlin. So we'll be back in the German capital next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Angel Feliciano. Hi, Angel.
Hi, Francine. BP has bought a stake in one of the world's largest clean energy projects. The Asian renewable energy hub aims to supply green hydrogen from Australia to key markets, including South Korea and Japan. BP's stake in the project comes to 40.5%. Green hydrogen is producing using water and renewable power and is forecast for rapid growth this decade. Caterpillar, known for making equipment shifting large amounts of dirt, is now moving its headquarters. It'll rebase itself in Texas, ending a century-long history, calling Illinois its home. The company says it wants to take advantage of two major airports in the region. Other large companies that have moved to Texas recently include Tesla and Oracle. Shares of the agency that manages Korean pop group BTS plunged by a record after members of the group said they will focus on individual projects for a little while. BTS made the announcement in an hour-long video posted on YouTube. One member, J-Hope, said that the time apart would be healthy for the band and urged fans not to view the development as negative. Bill Gates has dismissed cryptocurrency and NFTs as shams based on what he calls the greater fool theory. Speaking at a climate conference, Gates said digital banking efforts supported by his philanthropic foundations are hundreds of times more efficient than crypto. Gates sparred with Elon Musk last year over whether Bitcoin was too risky for retail investors and the environmental harm of mining coins. And that is your Bloomberg Business Flash. Francine?
Angel, thanks so much. Angel Feliciano in London. Now, the world's largest private equity and venture capital event, Super Return, is back this week. U.S.-based investment firm Franklin Templeton is at the event today, and so is our Danny Berger. Danny, over to you.
Hi, Francine. Thanks so much. Yeah, I'm joined now by Jenny Johnson, CEO of Franklin Templeton. Jenny, thank you so much for joining. Now, it's funny because, in a former life, I used to report on mutual funds. So obviously, I know Franklin Templeton really well, and that's what I think of. But just in the past month, 3 months, you've bought in Lexington, you've bought Alcentra, both in the private capital space. Why make these moves now?
So we now, although we're a $1.4 trillion asset manager, we now are a top 10 alternatives manager. So we have $257 billion once we close Alcentra. And, we did it because markets are moving in that space. Private asset market continues to grow. Less and less companies are going public. You have half the number of public companies that you had in 2000. So, as an asset manager, you have to be able to bring all these solutions to clients. We have Clarion Partners, which is real estate. You mentioned Lexington, secondary private equity, really great private credit. We also have venture capital, private equity, and hedge fund of funds.
When I look at someone like Alcentra, for example, about, $38 billion or so in assets, how difficult is it to buy a company like that and absorb it?
So, we've always looked at acquisitions in the asset management business. What are you buying? You're buying people and their expertise in their investment process. And so what's made it work for us with the acquisitions we've done is we leave that completely independent. And then at the center, we provide additional opt-in types of things like data science, technology access, support risk management, right? So our clients can feel comfortable that while they're getting the expertise of really a boutique manager, you're getting it on this $1.4 trillion platform that cares about our global reputation, global reach, and are going to invest in things like risk management, AI.
What has the client reaction been? Because a lot of these are very complicated products. Are they just, what is this? How does it work?
No, I think the biggest issue for clients is what is the impact on the investment team? And we can confidently say the investment team is going to remain independent, and if anything, it's really getting additional services added to
Is there any degree, though, which traditional asset allocation, stock, bonds, 60-40, they've been suffering a lot recently. Is there any element to which those aren't working anymore and you have to go into private markets?
So I think what's happened, a lot of regulatory, has pushed, and the wealth of private dollars that are there have made it so companies are waiting longer. So the average company in 2000 went public after 3 years. Now they're waiting 9 to 10 years, and that growth trajectory is actually captured in the private markets and like private equity. And so you have to figure out ways to bring that to really the mass investors. And I think there's constructive ways to do it, but it's an illiquid asset, so you have to do it. It's like running with scissors. You have to do it appropriately with the right vehicles.
I really want to ask you about that illiquid part. I think this is interesting because not only have you bought private capital, you've bought quants before too. Cliff Asness, who's a really famous quant, he recently was tweeting a lot of criticism of private capital, basically just saying it's a mathematical quirk that private capital is less volatile. He called it volatility laundering, saying that people are just paying more for a leveraged S&P 500 fund. Is there any validity to that?
Well, I think the returns have justified their fees. But again, I think it's because companies are waiting, and I think there's a lot of regulatory reasons why companies are choosing not to go public as long as they can stay private longer. So you have that. Number two, you have the ability to make longer-term investments in the private markets because you're not so focused on quarterly earnings. And so I think from a strategically positioning a business over the long run, there's some benefits to that. And I think that, that's the money's been there to stay private. And then on the private credit side, I think the capital requirements on banks have made it so that banks are only providing loans really to their biggest, best clients. And so that's created this opportunity for a massive private credit market.
Jenny, we have to wrap up soon here, but I really want to ask you, you were at a Morningstar conference last month. And you were asked what the conversation is like with your managers right now, and you said it's almost like being a therapist, which I absolutely love. Things have gotten a little more wild since then in markets. How has that conversation gone now?
No, I just think I think the job of any leader in this industry is to support the investment teams during the rough times. It's easier to be on the top, right? Nobody needs to be supported then. It's during the rough times and saying, hey, look at the growth guys have had a great run. Now growth is really having a hard time right now as rates go up. And so you support your team to make sure they stick to their investment process and not bleed into other areas. Just like value guys had a tendency to maybe go a little bit into the growth markets because they were tired of underperforming. And that's the worst thing. Clients hire you for your investment process.
Right. Well, I'm sure the value guys are feeling a little bit better about their thesis.
They are way better.
Jenny, thank you so much. Back to you, Francine.
Danny, thank you so much. Great conversation there with Jenny Johnson. Coming up, the Bitcoin rout hits its darkest phase as the crypto market tanks. We take a look at the state of play amongst digital currencies. That's coming up next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the bear market for Bitcoin has entered its deepest and darkest phase, with even long-term holders who had toughed it out until now coming under extreme pressure. That's according to strategists at Glassnode, which tracks an indicator known as realized price, the average purchase price of all Bitcoins in circulation. Now, let's bring in our senior crypto reporter, Joanna Ossinger. Joanna, always great to speak to you. What exactly is going on in the world of crypto? It seems like every day there's worse news.
Hey, Francine, that's about right. We're on our 9th straight day of declines for Bitcoin. It has been really tough ever since the Fed started hiking rates, but now these hot inflation numbers last Friday, that really fueled this. And now we have Celsius freezing withdrawals, and then we even have people cutting jobs, and we have some speculation about what's going on with different funds and their holdings. And so there are a lot of things going on with the crypto industry, and Bitcoin is threatening the 20,000 level now, and it was at 69,000 in November.
So, Joanna, you're mentioning basically this vague tweet by the founder of Three Arrows Capital saying we are working this out. Are we going to see these kind of vague statements from other parts? Is this like a watershed moment for cryptocurrencies?
Well, Three Arrows is a very much watched fund. They've been out there, and Suju in particular has been quite vocal on Twitter and this sort of thing. So, everybody wants to watch what he's doing. But there are likely other people who are going to be making such statements coming up. And, even these places doing the layoffs, they're saying we're laying off 18% of people, 20%, because they hired really fast on the way up, and now they're laying people off on the way down.
Joanna, thanks so much. Our senior crypto reporter there, Joanna Ossinger, with the very latest, of course, on some of these pretty intense crypto moves. Now, we also look at the ECB. This is the Fed day, but actually it's the ECB morning. We heard about 2 hours ago that they'd have this ad hoc emergency meeting to deal maybe with, well, they call it market moves, but it was definitely to deal with some of these widening spreads in European bond yields. So this is amid a sell-off that's hit euro area periphery. We understand through our reporting that officials will discuss the PEP reinvestments. The problem is that the PEP reinvestments, we knew it had flexibility, so that's not really reassuring the markets as much as it could have. Italian bond yields fall, euro rallies. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Kailey Leinz in New York, Anna Edwards in London, and this is Bloomberg.
It could be a tough couple of months here. We have complacency, we have denial, and we have fear. That is a perfect scenario where markets can be a little bit more behavioral and less efficient.
But the key question is, has the market priced in maximum Fed hawkishness? We don't think that it has.
Every time central banks have gone out shooting for inflation, they've caused a recession.
We're trying to sequence which central banks are moving. It looks like the ECB is ready to move.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, June 15th. Our top stories today. An ECB surprise. The central bank will hold an emergency meeting this hour to discuss market conditions. Italian bonds surge and the euro rallies. Fed ahead. Investors are bracing for the biggest Fed hike since 1994. Treasuries are recovering from one of the worst sell-offs in 4 decades. And we'll discuss all of this central bank action with the former Bank of England Governor, Mark Carney. He joins live from the Super Return Conference in Berlin. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, this was already a busy and really fascinating day with the Fed. The day just keeps getting busier.
It does indeed. It is a big central bank day, Anna, but we also have to talk about politics as well, because we do have some breaking headlines crossing the wire as it relates to Brexit. The EU is restarting legal action against the UK over Brexit laws. It will launch 2 new legal procedures against the UK. An EU official, though, saying that it will not remove the EU Court of Justice from the Brexit protocol. Of course, this all comes after the UK presented planned legislation to override parts of the Brexit withdrawal agreement surrounding, of course, the Northern Ireland Protocol. The EU's chief Brexit negotiator had hinted on this kind of action earlier this week, but again, the EU is restarting legal action against the UK over Brexit, so we will have more on that in just a moment. First, though, we do want to get you up to speed on what happened overnight in the Asian session. It really was mixed when it came to equities. On the one hand, you had outperformance coming from China. The CSI 300 was higher by about 1.3% after a lot of data out overnight that showed some improvement in the month of May. Industrial production rebounded, and yes, retail sales were still down 7%, but that was a less steep decline than we saw in the prior month, so that helped out risk sentiment there. You actually have Chinese equities at a 3-month high. Stocks were lower in Japan, though, and that may in part be due to the strength we are seeing for the Japanese yen, snapping 8 straight days of losses to the U.S. dollar. Right now, dollar yen trading around 134.59, so just off of the weakest levels since 1998. But of course, the yen, as well as other traders, hedge fund managers, are really testing the BOJ's resolve when it comes to yield curve control. The BOJ continually buying bonds to keep that 25 basis point cap on the 10-year yield, but how long is that realistically going to work? Because that 10-year JGB yield sitting at 0.256%. That, of course, is the question, Matt. And then elsewhere in global bond markets, of course, you saw that major selling pressure for treasuries over the last 2 days. Australia playing a bit of catch up to that, up 25 or so basis points on that 10-year treasury overnight, 4.2% where we trade, Matt, and that is the highest going back several years.
I got to say, with all the central bank action, and there is a lot going on today, I think the JGB story is one of the most interesting. I'm thinking about writing a column, things I could fund shorting JGBs right now, because it seems like there's no risk to that trade, only potential upside. Here in the U.S., we're looking at futures that are up just about 0.5%. We finished down about that much in the cash trade yesterday. It was the 5th consecutive day trading down on equities, the longest losing streak since January. So a little bit of respite today, maybe. 10-year yield coming back down a little bit, but look where we are. I mean, 342 right now on the 10-year yield, back at levels we haven't seen since early 2011. Obviously, the Fed is front and center and going to be incredibly exciting today. One trader told me other central banks are spinning out in the Fed's jet wash. It's like Top Gun. And the Fed is, I guess, jester in this case. That's the first Top Gun, by the way. Nymex Crude down more than $1 right now, 117.57. That feels relatively low for Texas Intermediate because we were up yesterday to like 124. So really coming off, and that may be what's giving a bounce to these markets. Right now, Bitcoin trading down from the price at midnight, 7.5%. $20,000, 336. That is lower than the average cost of all Bitcoin owners right now. So it's really difficult for the hodlers to hang on at this level, and it's getting down to a bottom that Mike Novogratz said it would hit around 19,000 and change. So it's definitely looking like continued drops for Bitcoin, let's say, and really a loss of confidence in the entire crypto universe. Anna, what do you see in terms of European markets ahead of the emergency ECB meeting?
An ad hoc emergency ECB meeting. Shield your eyes, Matt, from the brightness of the FTSE MIB on my European map today. Such are the gains that we're seeing coming through for Italian stocks. So European equity markets certainly moving higher this morning. The FTSE MIB up by more than 2.5% in today's session. And a lot of this has to do with financial services. The way that financial services have really been knocked back by concerns around divergent or fragmenting yields and the yield picture around the Eurozone. That has been a concern for markets over recent days. And now we're winding some of that back in anticipation that the ECB will do something or say something important about fragmentation. We'll have to hold our breaths and wait to see what we actually get there. This is the FTSE MIB then up by 2.4%. 30% of the FTSE MIB is made up of financial services. It's those stocks that were so beaten up as we saw Italian bond yields surge, and it's those stocks that gain as we see those yields come down. And these are the yields coming down. This is the 5-year. I could have looked at the 2s, the 10s, the 30. We see across the curve those yields coming down in anticipation that we get some comment. The CEO of Intesa Sanpaolo, one of the big banks in Italy, says he's clear about where the spread should be, 100 to 150 basis points in his view. It's wider than that right now. What does the ECB think, and what is the ECB minded to do, if anything, about that? This is the euro, also on the rise in anticipation that the ECB puts fragmentation and the risk that we see wider spreads, essentially. That's what fragmentation is, across the Eurozone. The euro rising in anticipation of that meeting. And I had to put this one in, Kailey, because this made me just feel so happy today. This is Bloomsbury, the publishing business based in London, the publisher of Harry Potter books. It wasn't just that during the pandemic we all learned to make cocktails and we all got new pets. We all rediscovered how to read. And it seems, according to the CEO this morning of Bloomsbury, we have not forgotten, once again, just because we are allowed to go out into the real world, we're all still reading.
All right, Anna, I know I still read fiction whenever I can because we talk a lot about really heavy stuff on these programs these days. So it's nice to get that escape through a book sometimes. All right, now as for what is ahead today, as we already mentioned, that ECB emergency meeting is just getting underway in Frankfurt. And we will also be hearing from President Christine Lagarde later today when she participates in a discussion hosted by the London School of Economics. We'll also be getting some U.S. economic data ahead of the Fed decision. U.S. retail sales coming at 8:30 a.m. New York time. Before we get that rate decision, 75 basis points is what this market is expecting, Matt. That's coming at 2 p.m. Eastern from the FOMC.
Yeah, to be honest, nothing else matters. Brexit be damned. It's all about central banks today. And we'll kick it off with the ECB's emergency meeting this hour on market conditions. EU Finance Commissioner Mairead McGuinness weighed in on the central bank earlier on Bloomberg.
The ECB is doing its job, so I think that's important. I'm not going to second guess the conversations that will take place at this meeting, but clearly since the beginning of this year, and particularly since the invasion, the illegal invasion by Russia of Ukraine, there is uncertainty in markets. Full faith in our institutions to deal with uncertainty and prudence as well, so that we are ahead of issues. So let's see what emerges, but clearly the ECB is right to be active and to do its job.
Bloomberg's Maria Tadeo joins us now out of Brussels. So what do we know, Maria? Are we going to get giant rate hikes here? Are they going to come in and backstop peripheral debt?
Well, Matt, I don't think we get a rate hike today. If you believe, again, Christine Lagarde last week when she said, we're going to really calligraph and tell you in advance the way that we're going to move its 25 basis points for July. You know, to undo that, you could argue could do a lot of damage to the credibility of the central bank. I think the question here, and if you go back and you take a step back here, all of this, the moves that we're seeing in the European bond market, particularly in the BTP, yesterday 4%, that 10-year, it goes back to that press conference almost a week to the date today in which Christine Lagarde was asked 4 times. I was in that press conference, what are you going to do to fight the fragmentation in the market? And she said, we'll do what we have to do, but there was no detail. There was very little substance to that. And of course, the market has been testing the ECB day in and day out since she failed to provide that detail. So a lot of this will be about the fragmentation, whether or not there's a new tool, whether or not the European Central Bank is ready to do something immediately to calm some of these nerves. But I do have to say, and as we're reporting now on Bloomberg, a lot of the conversation will focus on the PEP reinvestment. We knew that was flexible. So for what I hear from a lot of the traders I've talked to this morning is that if this meeting just ends with a soft line on the reinvestment, you could be in for a big disappointment.
Markets still looking out for something, it seems. Certainly, you read that into what we see on the euro and the moves that we've seen in Italian debt. Maria, that's the monetary policy focus here in Europe for the day. Let's turn to the politics and the politics of Brexit. The UK proposed a bill earlier on this week, which, of course, would rip up parts of the Northern Ireland Protocol. The EU, of course, doesn't like that. Maros Sefcovic speaking this hour saying the UK decision left us with no choice but to act. They've launched legal action against the UK over the Brexit bill. What do we expect to see here?
Anna, it's a never-ending story. I think that you and I have talked about this for maybe 3-4 years, and we'll probably have another 5 years to talk about this. And look, I think you summarized it very well. The UK government says this Brexit deal, parts of it, particularly in regards to the Northern Ireland Protocol, worked great on paper, but it doesn't work in real life, so we're going to change it unilaterally. The European, of course, authorities, they say that's not how it works, and now, once again, they say they will trigger action on this, legal action. By the way, to me, what is key here, however, is that they still say they remain open to a potential solution. They could have really escalated today by perhaps throwing in tariffs, and they haven't done that yet. So it's not a full-blown trade war.
Okay, Maria, thanks very much. Bloomberg's Maria today with the latest from Brussels on the European response, monetary policy, and the European response to the latest Brexit moves. Now let's get back to central banking and the focus we thought we would have, pure and simple today, around the Fed. Consensus is building for a 75 basis point Fed rate hike. Bill Ackman says 100 basis points would be better, while Jeff Gundlach goes one step further, a few steps further, and urges Powell to take rates to 3% in one go. Let's get to Mike McKee, Bloomberg International Economics and Policy Correspondent, for more on what to expect from today's Fed decision. I don't think we think that 3% is on the cards, Mike, but take us through the expectation.
Yeah, I don't think 3% is in the cards, but isn't this fun, Anna? I mean, it's been a very long time since the decision itself mattered. Usually we talk about what's to come and the statement, but in this case, we aren't really sure, although there is a feeling in the markets, and the markets have repriced, that the Fed will do 75. It was locked in to be 50 until Monday, when a series of media stories reported 75 is on the table, and markets priced in 75 basis points for this move. And then look at that top line there. Markets have already priced in another 75 for July. Now, this doesn't mean the future guidance is irrelevant, because everybody's going to want to know if that July move is ratified by the dot plot. When you take a look at the dot plot now and you see what the Fed was proposing at its last meeting, the last time in March when they released a dot plot and forecasts, you can see the lower line there is where the market thought the Fed would be. Now the white line up top is where they think they should be. So on the left-hand side, a lot of room between where they are and where the market wants them to go. And then on the 2023 dot, what's the terminal rate? How high do they think they have to go? That's going to be one of the key questions everybody is watching today.
Absolutely. And of course, for our listeners on radio, you can find that dot plot on DotsGo when you get logged onto your Bloomberg terminal, and all the great charts we talk about on this program are available on GTV Go. Bloomberg's Michael McKee in Washington, thank you so much. And don't forget, stay with Bloomberg for special coverage of the Fed decision and news conference. Mike will be there. That starts at 1:30 p.m. in New York, 6:30 p.m. in London. Meanwhile, ahead of that decision, global bonds are on the cusp of entering a bear market. That's, of course, after the U.S. inflation hit the highest in 4 decades, fueling bets that the Fed will make that aggressive move today. Let's get more with Bloomberg's Kriti Gupta. Kriti, this is not somewhere we've been in a long time.
Not since 1994, if we do get that 75 basis point hike, which makes this market move so much more interesting. You have the bond market that is dropping potentially 20% from its peak, not just the U.S. market, but globally. Let me give you a statistic here. I'm going to throw some numbers at you first thing in the morning. Parallel to the 90s, this would be the biggest annual, the third time, 3 times the size of the biggest annual loss since 1990. As the market has grown bigger and bigger in the last 30 years, exactly, that same move, making those parallels to 1994 of the 75 basis point, the ripple effects are going to be so much higher. And of course, Kailey, we know that we've been talking a lot about these big increases in the bond market, in these yields, especially when you talk about the yield premium. It's the rate of change that matters here. 20 basis point moves all in one day.
1994, I'm going to say a couple years before you were born.
Get that in there.
15 years before Bitcoin, before the white paper was even written. But the crypto market has been roiling plain vanilla assets as well.
Yeah, well, speaking of a bear market, a lot of it comes down to liquidity. The same issues that we're talking about in the broader markets, in the S&P 500, in the bond market. Valuations, liquidity, it's the same thing hitting crypto. And of course, you do have some storylines within that as well. Of course, we know yesterday on your crypto show, you guys were talking about Celsius, the network, the crypto lending network that had paused withdrawals, swaps, and transfers. That adding to it this morning, you have another crypto hedge fund, Three Arrows Capital, which has actually been known for really championing, stumbling over my words this morning. So excited about the Fed day, clearly. But they're also looking to liquidate some of their crypto holdings. So the idea here is that is crypto still that
with some of their staked ether already.
Yeah. Exactly. And if the question here is, with all that Fed angst, is crypto really worth what it used to be? And is it still going to be that inflation hedge? Does it still belong in a traditional portfolio?
All right, Critty, thanks very much. I look forward to talking to you about this all day long. Let's get to Washington now. U.S. Democrats appear to be considering new energy legislation. Sources say Oregon Senator Ron Wyden may propose a surtax of up to 42% on companies that record a profit margin better than 10%. I guess we're now calling that excessive profit. Meanwhile, President Biden has not ruled out the idea of an oil windfall tax either. The deputy director of the National Economic Council spoke yesterday.
What the president has made clear is that there's a real issue here with the level of production by the oil companies and the profits that they are making right now after the Russian invasion of Ukraine.
Anne-Marie Horton, Bloomberg Washington correspondent, joins us now from D.C. for more. So this is, I guess, not really encouraging in terms of future investment.
Well, no, but Matt, I mean, the bottom line is if this was going to become law, you need 50 Democratic senators to get on board with it. That is going to be tough. And not only that, it likely would not happen anytime soon, right? So what the administration really wants to do is have a policy that can impact gasoline prices, which are another record today. But that is not going to happen if this was to become a law by the time voters go to the polls for the midterms. But what it is another messaging tool that this administration can use to talk about what they're doing to combat inflation and higher gasoline prices. You heard the president last week said Exxon made more money than God, his words, and saying that he wants everyone to know what their profits are. So this kind of surtax is something that has some aides, gets their ears perked up. They like the idea of it. But others internally also worried, what does this mean for actual supply? But you will see more messaging like this. Just 10 minutes ago, we learned of a letter the president sent top oil companies talking about refinery capacity, saying that they need to take immediate action. And what's happening is unfair, that they are passing on what is going on with the war in Ukraine, the reopening of the economy, they say, passing this on to consumers.
Interesting if the US goes down this route. Of course, a number of governments in Europe have already done this and applied such taxes. Thanks very much to Bloomberg's Anne-Marie Horton in Washington. Coming up on the programme then, live from the Super Return Conference in Berlin, Mark Carney, Brookfield Vice Chair, and of course, former Bank of England Governor, former Governor of the Bank of Canada as well. We will talk to him about climate change, about investors' role in that, and of course, crucially, on such a big day for central banking, get his thoughts. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition on Fed Day. I'm Matt Miller in New York, here with Kailey Leinz, Anna Edwards with us out of London. I am looking at inflation expectations. These numbers came out on Friday with the University of Michigan consumer confidence level at a record low, and inflation expectations are starting to get unanchored. This is what the Fed is fighting against. Justina Lee, Bloomberg Markets reporter, joins us now. Justina, what can we expect from Jay Powell and co.?
Well, today markets are expecting possibly a 75 basis point hike. I mean, a lot of economists are still split about that. Will we get 75 or 50? But I think your chart is a really great illustration of what the Fed is grappling with right now, because they're worried that inflation expectations are going to be entrenched. And to prevent that, they really need to act decisively. And that's why we're kind of seeing this big reaction across stock, bond, and even crypto markets right now.
So, Justina, that is what the Fed is wrestling with. Surprisingly, we get this unexpected meeting from the ECB today. Remind us what they are wrestling with, because it's not actually maybe the pace of hikes that's in focus. Maybe it's the conversation around spreads and peripheral bond yields in focus today.
Right, exactly. I mean, we're starting to see a bit of fragmentation in the Eurozone bond market, which of course is pretty worrying, is reminiscent of like the Eurozone debt crisis from a few years ago. And what's happening here is like investors have become a bit more discerning about, issuers with different levels of debt now that it seems like the ECB is also kind of thinking about monetary tightening as well.
Okay, and we'll watch to see what the ECB reveals then. Meeting at this moment, we understand. Thanks to Bloomberg's Justina Lee. For more market analysis, check out MLIV Go on the terminal. That is the place to find the Markets Live blog. This is Bloomberg.
Now keeping you up to date with news from around the world, here is the first word. China's economy had a mixed recovery in May as COVID restrictions eased. Industrial output rose 0.7% from a year ago, while the almost 7% contraction in retail sales was better than the prior month. The property market also contracted. According to his latest tweet, Tesla CEO Elon Musk says he's thinking of creating a super moderate super PAC. This political action committee would support candidates with centrist views from all parties. And another vague tweet by a founder of Three Arrows Capital, an influential hedge fund that has been liquidating crypto holdings, is creating new apprehension in the industry. Suzu tweeted that his group was, quote, fully committed to working this out without providing further details. There's been no further comment from him. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. An ECB surprise. The central bank will hold an emergency meeting this hour to discuss market conditions. Italian bonds surge and the euro rallies. Fed ahead. Investors are bracing for the biggest Fed hike since 1994. Treasuries are recovering from one of the worst sell-offs in 4 decades. And we'll discuss all of this central bank action with the former Bank of England Governor Mark Carney. He joins live from the Super Return Conference in Berlin. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. But Matt, interesting to see where European equity markets are right now. Certainly a lot of anticipation about what the ECB has to say. And of course, we know they're meeting this hour.
Yeah, I mean, the ECB is meeting now. The Fed is meeting later. The Bank of England, I think, tomorrow. And we're going to get more from the BOJ as the market pushes JGB futures. So there is a lot going on in the macro world. Right now, we have S&P futures up 0.5% after 5 days in a row of drops, the longest losing streak for stocks. You may have noticed if you're long, it's been painful since January. The U.S. 10-year yield coming down, but down to 341. So really high levels, decade high levels, or more than that as we get ready for a Fed rate hike of the biggest size we've seen since 1994. Just last week it was supposed to be 50. Then over the weekend you heard people talking about 75. Now more people are coming out of the woodwork talking about 100 or even double that if you listen to Jeff Gundlach. So we're really set up for a lot of interesting action today. Nymex Crude coming down 1 1/3% to 117.37. This is a huge move if you think about where it was yesterday noon. It was at like 123 and change. So Nymex Crude coming down, that could give some respite to the market. And Bitcoin, again, a very disappointing day for those long crypto, down 8% at 20,186. It's now well under the level that is calculated as the buy-in price for everyone that holds it, the global kind of average by Glassnode. So that puts a lot of pressure on those holders. Kailey, what do you see in terms of the pre-market movers?
Well, it all comes down to that crypto story. That loss for Bitcoin today is the 9th down day in a row, which is the longest losing streak going back all the way to 2014. It has been absolutely brutal, and it has been brutal too for equities tied to crypto in some form or fashion. The likes of Riot Blockchain, Marathon Digital, they're each down another 7% in pre-market trading this morning, while Coinbase could be lower for a 7th day in a row. The stock already down some 27% over the last 6 days. It's down another 7% in early hours this morning. And of course, we got news out of Coinbase yesterday that it's cutting 18% of its workforce due to this crypto winter. And finally, I wanted to point to MicroStrategy as well. This, of course, holds a lot of Bitcoin on its balance sheet. It has a loan tied to Bitcoin with its collateral. There was concern that there may be a margin call. Now, Michael Saylor, the CEO, came out yesterday and said, no margin call here. We have plenty of other, we can post collateral with some of our other assets. So that did see some relief for the stock in yesterday's session, but it's right back down this morning, down nearly 9%. It is down more than 70% on the year so far, Anna.
Yeah, interesting to see crypto so weak today. Often we've said how it moves with risk assets. Well, it's a lot weaker than risk assets in today's session, whether you look at what stocks futures are doing or when you look at some of the riskier ends of the European equity markets. Broadly speaking, European stocks are moving higher today in anticipation of this ECB meeting. More on that in just a moment, but up by 0.9% on the Stocks Europe 600. This is the FTSE MIB getting the best of those gains, up by 2.6%. 30% of this index is financial services, and it's that sector that was so beaten up at the time that we saw those yields in Italy in particular really spiking. Those yields really spiked, coming down today, down 28 basis points on the 5-year yield. I could have chosen 2s, 10s, or 30s. We're seeing across the Italian curve those yields coming down, as it does seem as if the ECB is set to do something or say something around fragmentation. That's the spread widening in the Eurozone. So Italian spreads, Italian yields much higher than German yields, of course. That's what we mean by talking about fragmentation. And here's the euro in anticipation of this meeting as well, up 0.6%, 104.83. Let us get more on what to expect from the ECB, this emergency meeting taking place today. We understand taking place now. Bloomberg's Maria Tadeo helping us keep track of all of the news lines coming on this story today. Maria, it's really fascinating. When we saw this meeting called initially, some people said, well, are they going to do more rate hikes? Is that what this is about? Others said, hang on, maybe this is more about fragmentation. The euro seems to have been moving on the fragmentation story and the fears around that. What can you tell us about what to expect?
Yes, Anna, and look, I think that if you go back a week ago when Christine Lagarde, of course, gave that monetary policy decision and that press conference, I think she calibrated very well the rate path from now on is 25 basis points in July, and then, of course, the door is open for 50 depending on the inflation print. So today, to backtrack on that could really do a lot of damage to the credibility of the institution. I think the issue here, and this is really what started the volatility in the European bond market, particularly around the 10-year BTP mark, is the fragmentation, the big jitters that we see in the periphery as a result of the hiking path that the European Central Bank is going to embark on. So the focus does seem to be on the fragmentation. Yesterday, Isabel Schnabel, who, as you know, this is someone that, of course, everyone listens to, pays attention to when she speaks. She says the commitment of the European Central Bank to fight the fragmentation, an anti-fragmentation tool, has, quote, no limit. So I think today the market really wants to see the detail around that, and they want to see the substance behind it. The issue, however, is that if this is a meeting that talks just about reinvesting, that doesn't really tackle this issue head on, we could find ourselves in a deja vu of last week. Essentially, a disappointed market, underwhelming, and none of this will serve to address the core issues. So there has been a lot of optimism this market in the European market. Of course, we saw stocks up, yields are down, but there is a lot of room for disappointment here.
Yeah, absolutely. I think if you short the euro and BTPs, that could be the safe side of the ledger today. Maria Tadeo in Brussels, thanks very much for that. Now, Ben Emons, Managing Director of Macro Strategy at Medley Global Advisors, joins us to discuss all of this central bank action. Ben, I guess we should start with the Fed because one trader this morning described it to me as like Top Gun. All these other central banks are spinning out in the Fed's jet wash. Is that what's happening?
To an extent, Matt, I think indeed that the Fed meeting is going to lead to reaction, say, with the Bank of Japan, you were earlier highlighting, because they're waiting for what's the outcome of this meeting precisely. But, we're dealing with fragmentation in the Eurozone markets. So this meeting called by the ECB is also addressing basically the amplified effect from CPI on Friday and what the Fed will do. So, yes, the Fed is the center of attention. And, we can expect they floated the 75 basis point hike through the press on Monday. So that you can likely expect. Moreover, the communication from there is really key to the markets. Like what type of steps you're going to take, given that the forward guidance that they're given in March and in May for the June-July meeting wasn't so successful, where we ended up in a much different place.
Ben, we've had admittedly outlier voices calling for bigger hikes than 75 Ackman saying 100, Gundlach saying 200, and other people saying, like, this is a moment where Powell could be the Volckerian hero if he just breaks inflation now and gives the Fed credibility back. Why don't they just do that?
Yeah, I think it's not so straightforward, Matt. Like, we do deal with a different system than in the 1980s, right? Because this is a very levered, sophisticated, complex system. If you just look at what's going on in crypto, as you brought in the segment, that's still down today, right? It's not responding to this risk-on reaction to the ECB. Just amplifies, or actually, I think, more highlights what the leverage, the complexity there is going on. So hiking by 100, 200, 300 basis points, yes, it probably will take inflation expectations in the future down. But at the same time, you're going to deal with deleveraging in financial markets. So there's a trade-off here. So you could expect more that let's say, 75 middle of the road option, and then signal that you're going to do more of those if you feel that the inflation is not going your way. So I get the idea of Volcker being right ahead and being a big hitter at the plate, but you do deal with a complex market.
Well, Ben, so little has been done already. This market has moved dramatically, and yet QT has only just begun. We've only actually seen rates go higher by 75 basis points to this point, and yet you have seen ripple effects across asset classes, including credit, where you're starting to see some real bleeding. If this market keeps front-running the Fed, how long is it going to be before the Fed put comes back in?
I think on credit, that's a critical point, Kailey, because we talk about the equity put, and people try to quantify that on past drawdowns of the S&P and how the Fed responded. But take us back to March of 2020, when we really had a cratering credit market because we shut down the economy. If that is the result of QT, then you could receive some level of response to that, because ultimately it's about transmission of policy, right? This is why the ECB is meeting. If you want to hike rates and it's not transmitting effectively, that's the same for the Fed. If credit markets completely seize up, then there's no point in hiking, right? So therefore, that will be of a focus. I don't think for this meeting, by the way, but you will get an attention to that, because otherwise, you end up in a complete spiral downwards.
Ben, can I take us to the other big central banking event of the day, and that's the surprise emergency meeting of the Governing Council at the ECB. What will you be watching for? What will be enough when it comes to tackling the market's concerns about fragmentation?
Yeah, the word enough, and that's what I think is for everyone the focus here. We kind of know what the tools are about. You have the PEP program, you can reinvest those proceeds, and you can be flexible investing those proceeds like they did in April of 2020. They assigned more bond purchases to Italian bonds instead of German bonds. So they can do things like that. They can think of a pass tool like the securities market program, where they do sterilized purchases. Obviously, they could revise the OMT program too. So we know the tools that are there. I think the market reaction, the way I look at it, is that this is sort of your I think, classic response to, you want to step in when things are really illiquid to try to cap to an extent those spreads and keep markets again functioning. So what's enough? I think it's a combination of having the emergency program ready, that you can be flexible, and giving some guidance around how long you're going to do that. I think that's what the market will probably be looking for.
Ben, thanks so much. Thanks for your time. Thanks to Ben Emons of Medley Global Advisors. Coming up on the programme, we will stick with the theme of central banking, live from the Super Return Conference in Berlin. Mark Carney, now, of course, Brookfield Vice Chair, with a lot to say on climate change and investing around those themes. Also, former Bank of England Governor. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Let's go now to the Super Return Conference in Berlin. Bloomberg's Danny Berger is standing by with Mark Carney, former Bank of England Governor, who's now Vice Chair at Brookfield. Danny?
Anna, thanks so much. That's right. I'm here with Mark. Mark, thank you so much for joining. So about 45 minutes ago, let's say 300 miles away from where we're sitting, an emergency meeting from the ECB as the periphery spread blows out. You've been in the rooms like this before. What must that be like? How difficult is it for central banks right now?
Well, it's I'm going to say it's an extraordinary meeting as opposed to emergency meeting. As a central banker, you always try and calibrate these things. Look, it's a very unusual situation. In the meetings that I was in, we needed stimulus, and we needed to support market functioning in an environment of really negative shocks. The main shock now is that central banks are withdrawing stimulus or prospectively withdrawing stimulus. And so it's an unusual situation to be taking away with one hand, prospectively in the case of the ECB, but looking at how you can support market functioning, give with the other hand. And so they really have a fine line to walk.
Right, it is this issue of can the ECB stand still, just do 25 basis points when you have the Fed going ahead with 75 in a jumbo hike?
Yeah, well, look, different economies, different inflation dynamics. The ECB, rightly in my judgment, has now pulled forward tightening, ending quantitative easing, being pretty clear that they're on a path to tightening. But they have this issue in terms of the integrity of the euro, peripheral spreads, making sure there should be some widening of spreads, just to be clear, in a tightening environment.
But have they widened too much that it makes sense to do this?
That's the judgment they have to make. And I think more about the market functioning and ensuring, this is a monetary institution, and what they want to ensure is that monetary policy transmission is working and they're not getting outsized impacts because of spread widening in the periphery relative to the core tightening of policy that's needed for the euro area as a whole.
Well, of course, it's not just Europe that's had this market reaction. The U.S., this momentous reaction with 75 basis points getting baked into the decision today. Do central bankers, does the Fed, do they need to shock the markets with these type of huge moves?
Well, I think what central bankers, and let's assume the Fed does 75 basis points, we'll find out in a few hours. I think what's clear is central bankers need to catch up to their economies. They've been behind the curves, they've acknowledged this, and they need to start to get interest rates above inflation effectively, or at least prospective inflation expectations. So right now, as you know, you reported last Friday, inflation expectations in the U.S., at least under consumer expectations, 3.3%. So you're not going to start to bring inflation down if your policy rate is materially below that. They need to start moving more rapidly.
Does it make sense to front load those?
Well, to the extent you can, it does make sense. If you're far behind, it does make sense to front load, just like the converse was. We front loaded some pretty big cuts when there was sharp shocks. I think what is as important, though, if I may, Danny, today is not, obviously it matters whether it's 75 basis points, but what really matters, to me at least, is what is the committee saying about the future path of rates? Is there potentially, are we getting to 3.25%, 3.5% by the end of this year? Pardon me?
Do you think they'll go to 4%? Market pricing that in for 2023?
Look, I think ultimately perhaps being in that range of 4% will be necessary. Remember, they also have some quantitative tightening as well. Two other things, though, I would look for. One is, where do they think the longer-term interest rates are going to be, the so-called equilibrium rate? Back in March, the average was 2.5%. My personal view, that's no longer realistic given the shifts in the global economy. That should be higher. And then as well, very importantly, again in March, it didn't feel credible that inflation could come down without unemployment moving up from these very tight levels.
At that time, though, people who held that opinion said because the Fed is behind, once they have to do what they're doing now, they're going to front load, therefore they're going to break something. Does it feel like we're getting to that point where something might break?
Well, I would distinguish in the economy. Look, we had this huge shock of COVID. We had a lot of people who couldn't work for 18 months, 24 months. We had an acceleration of the digital transformation. We've had a lot of other shifts in the global economy. So not surprisingly, the equilibrium rate, I'm talking like a central banker because I was one, the level of unemployment in the economy that's consistent with price stability has gone up in the U.S. Now, I don't know precisely where it's gone, but it's probably 4.25%, 4.5%. And the Fed had been acting as if it was still like it was before COVID, before all these shocks happened. That wasn't fully credible. Right. And so I wouldn't call that breaking something. It's moving the economy back to where it needs to be. That's not a great thing to happen, obviously for the people who become unemployed, but it's a necessary thing to happen.
You look at the BOE as well, your former colleagues there, the market pricing them in 2% for next year. Is it the same? Can they get to that level and the UK economy still support it?
Well, the UK economy has had the shocks that the US economy has had, the German economy for that matter, the COVID-related shocks, the global shocks. It also has the impact of Brexit acting at the same time, which is another supply shock, at least over the monetary policy horizon. So there's a less of a reserve army of labor. There's a bigger restructuring going on within the economy. Both of those add to inflationary pressures in the UK economy, even though it has slowed quite dramatically. So, it's a challenge for the MPC. I have full confidence that they will get it right.
Yeah, but now you get to just be an observer rather than feeling the drama yourself. So. Well, speaking of which, Mark, I of course can't let you go without asking about your job currently at Brookfield, the transition fund. How much, though, is investing in a world that moves to net zero? How much is that complicated by the fact that there's a war going on where we're trying to plug that hole left by Russia and in some ways moving to dirtier fuel sources right now?
Well, we're sitting here in Berlin, and let's look what the Germans have done, the Europeans have done. 3.5-time increase in clean power this decade, that's clear. They've accelerated the approval process from 6 years to 1 year for clean energy, 4 times the rate on hydrogen. All those decisions have come in over the course of the last 2 months, and Germany targeting 100% clean power by 2035. So because of the war, they're accelerating the net zero transition. That's not, that's the bigger picture. And we're seeing similar things in other jurisdictions. That is not to diminish, though, the very near-term pain and scramble for hydrocarbons in the short term.
Mark, I'm afraid we're just out of time. We're going to have to leave it there. I really appreciate it, though. Matt, Kailey, Anna, Mark Carney, Vice Chair at Brookfield.
Danny, thanks very much. Thanks to Danny. Thanks to Mark Carney, of course, as well. Really interesting conversation there. They started that conversation on the ECB, and we've just got some breaking news lines on the ECB. Our colleagues uncovering this for us. The ECB is going to be discussing the crisis strategy as well as PEP reinvestments. So when we saw those headlines earlier that said the ECB might be meeting for this emergency meeting just to talk about whether they might reinvest the proceeds of PEP, the assets they hold under the PEP program, the Pandemic Emergency Bond Buying Program, that led to a lot of voices saying, hang on, is that all? Christine Lagarde already told us that. Well, now we know that they're going to take this broader. They're discussing a broader strategy to protect the integrity of the euro region, as well as these PEP reinvestments. More coming up on central banking, that's for sure, as we go through the day. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. And guys, this is like the ultimate central bank day. It was supposed to be a day all about the Federal Reserve, poised for the biggest rate hike going all the way back to 1994, 75 basis points. And yet somehow the ECB finds a way to swoop in and steal some of that spotlight, Matt.
Yeah, absolutely. It feels like when Ford was bringing out the Bronco and Jeep dropped the 392 Wrangler.
Oh, yes, of course.
Yeah.
Just like that day.
It's an incredible day for central bank news. And I think it's amazing because of the way assets are moving, right? The euro and BTPs are positioned for some real action from Christine Lagarde, but are they really going to get it? Meanwhile, traders are daring the Bank of Japan to hold to their strategy. That's just 2 days away. And we're expecting 75 basis points from the Fed, the biggest hike since 1994.
Yeah, not to mention the Bank of England tomorrow as well. So a lot to talk about. We'll certainly focus in on what the ECB has to say over the next hours as we wait for the Fed's decision later on. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.